What's
Hey
up, Rob?
guys, happy Friday.
Happy Friday.
I like your Armstrong Dixon gear, Robin.
Thank you. I have to always work for us. I've
So what are you working on?
been working on a lot of long-term care and just term insurance lately. What about you guys?
Reviews, communication with clients, and a lot of fun stuff, a lot of investments, portfolio changes, but uh, it's been good.
Yeah, Robin, I'm fully refreshed on my long-term care. I did my 4-hour state required refresher course last night, so I'm a little tired, a little sick of clicking through slides, but I'm refreshed. Got my 4 hours, ready to talk long-term care if we want.
So as
And
a firm expert at this point, what is the importance of long-term care, Joe?
I'm an expert by state mandated continuing education course. Yes, that's right. This is my turn came up. How I think about long-term care, especially talking to clients, is like this is the thing nobody ever wants to talk about because it's kind of the scenario that we really don't want to face. Like we're all aware we're going to die. We've all at some level kind of accepted that and understood it. But I don't think everybody's sort of come to terms with the possibility or even probability that they're going to be frail at some point. And that's a really hard conversation. Frankly, I'm not really good at it.
I just asked how long chicken's good for.
Now you got background. Somebody's
Oh,
chatting.
sorry.
So, frankly, I'm not very good at it, but I think it's such an important thing for clients to at least have that hard conversation. And my wife and I did. Like, I'm younger, certainly than the average person buying long-term care. I tried to get it. I didn't qualify for it. My wife got it, so we got a policy on her. But like to me, that's the worst case scenario. Like, not only cannot provide for my family and my wife, I also can't necessarily take care of myself. And that's a hard thing to face, I think, for anybody. So it's normal that it's a conversation that's not really thought about.
Yeah.
But one of the stats I saw last night is for a 65-year-old, there's a 70% chance that at some point they're going to need some type of either in-home care, assisted living, nursing care, or hospice care. So, we'd spend a lot of time talking about risks that never happen. And to say something is a 70% probability for a 65-year-old, I mean, that's not really even a risk. Like that's a probable outcome of what's coming. Nav, I know you have some obviously some knowledge on this, but also some like personal experience, kind of working through this. So how do you think about the concept? And then we can dive into a little bit of insurance.
Yeah, no, I mean it's shocking that it's 70%. I remember when I first really dove into long-term care, fresh in the industry, and it was high 50s. So it's not a problem that's going away. It's really going up. And I think of it as a risk to a client's portfolio, especially if they're in the high net worth range, middle class, worked all their lives, saved up for a good retirement, have a few $1 million in the bank, in their investments. And if they end up being in long-term care for extended stay, it could really drain their assets over time. So I like to think of it as an asset protection tool for a specific set of clients. It can really work for clients ultra high net worth that want to leverage their funds as well. But then if you are, I'd say in the lower class, don't have a ton of money put away for retirement, there is a way you can get long-term care from the state through Medicaid, but that means you have to sell, basically have no assets. So it's not the outcome you want. So I think of it as a way to leverage your funds, protect your assets, because you're giving money to an insurance company to protect against this specific risk, which is now at 70% for a 65-year-old. That says, hey, I'll give you a pool of money. If this happens, I'm guaranteed to get X amount of dollars towards this cost. And my parents run an assisted living. So I've seen how much it does cost to be in an assisted living care, which is very popular. It's similar to having at-home nurse care, but in a lot of states, it's $5,000, $6,000, $7,000 on average a month to get this kind of care. So when you think of that over a 3, 4, 5, 6 year span, that's a lot of money going towards one specific thing.
It could
So
completely
that's why we like it.
things.
Right. right? So it's that's why I kind of think of it with the leverage is you're giving a pool of money to the insurance company, they're giving you a much bigger pool to pull from to provide for this care.
So typically, when do we even start speaking to clients about long-term care? Is that something we broach the topic with them every year? Do we wait till they turn a certain age before we feel like it's really important to start talking about it?
So I like to think of it kind of the sweet spot. Everybody's different, right? So like, let's start there. Everybody's circumstance is unique, but if we're going to make a generalization, you have kids in your household, you're raising kids, you got a bunch of bills. The last thing on your mind is like when you're old and frail, right? You're trying to kind of raise kids up, or advance in your career, depending on what your family situation is. And then you kind of hit a point where you're like, okay, I've saved some for retirement. I've raised my kids. They're either out of high school or out of college, or they're starting to get on their feet. Your need for essentially providing for those other people is dwindling, but the responsibility of essentially taking care of yourself, and even you can't take care of yourself, is increasing. Now I might have better numbers, but like I typically think of that of like 55 to 60 is kind of like that probably top of the bell curve. But like I said, I'm 38, and we put that in place for us. So I'm on the younger end of the bell curve. The challenge is if you're, not younger, you're at 58, and then you go further, is you might not be able to qualify because of health conditions. So that becomes more problematic. And Nav said before, you got to sell your assets. It's not really selling them. It's I'm the oldest person on the call. You guys know who Richard Pryor is?
Yes.
You ever see Brewster's Millions?
No.
No, I have not.
All right, your homework assignment is go watch Brewster's Millions. The gist of the show is he gets at $30 million and he's got to spend it in 30 days. And at the end of 30 days, he's got to have nothing more than the clothes on his back that he walked in with. So it's not, when Am said sell, it's not like you're selling your stuff, or it's not like you're buying a house and hiding the money. It's like, no. You got to come to Medicaid with no money. So you have to spend it all, like Brewster's Millions doing that. It's a good comedy. It's like probably early 90s, maybe late 80s. He like runs for political office. He buys a baseball team. He does a bunch of other like movie stuff. But it's a good movie. So I would suggest you watch that. But that's, people don't work their whole lives to say, okay, now I'm just going to literally waste all of my money so that I can qualify for Medicaid, which essentially means the state is going to tell you where you're going to spend your final days, which, isn't necessarily a great plan for, if you have living parents, like thinking about your parents or thinking about yourself, like that's not the end that you picture.
You want to put yourself in a position where you have options.
Bingo.
Exactly. Yep.
Yep.
And I find we tend to start talking to clients about it at age 50. But we've seen clients who are younger who have parents going through it and they see, hey, I don't want to be in this position. Can we start talking about long-term care sooner? And the answer is, of course, yes. And then we can give them the various options that come with long-term care insurance. So, Robin, I know one of the ones you were working on was a hybrid policy, but there are different types of long-term care policies.
Yeah, and that Robin is our newly licensed. Congratulations for passing that.
Yes.
I'm familiar with this too, but the biggest drawback, at least I typically hear on long-term care, is no one like says, hey, I can't wait till I have to have somebody help me prepare my meals. Or gee, I'm really looking forward to that day that I can't move from my bed to my chair. So they don't want that. So then the last thing they want to do is buy insurance for a scenario they don't want anyway. So the most common like pushback on the conversation is, well, what if I die peacefully in my sleep and I never need it, which is what people want to do, right? That's what I want to do. I don't want to be burdened. And that's what Nam's talking about, that hybrid will provide a death benefit. So essentially all the money you're paying in premium is either going to come out to pay for care or it's going to be paid to a beneficiary on the policy. So that hybrid approach tends to be better in our market of the clients that we're talking to. But I think the most challenging thing I've experienced is just getting people to really engage in the conversation and saying, oh, my wife's going to take me outside and shoot me when I'm 80. Like that's not really engaging in the conversation.
Right.
That's avoidance of a tough topic.
Agreed. Yeah, and it's, there's options. It's some clients will say, well, I'll just self-insure. And that's when we say, hey, you can self-insure, but to get the same leverage and the same amount of payments to get the same coverage from your own portfolio takes a lot more. And it's not always the most viable option because the risk, things change in your life, you might need it for something else. Funds might be diminished elsewhere. And if you want to leave an inheritance, then this is a much better way to protect your assets to leave an inheritance because they're not pulling funds for your care. So a lot of different ways. And another thing is just the cost. A lot of things that clients talk about is, hey, this is fairly expensive for a possibility of never using it. So that's why hybrid can be a way to say, hey, you're at least going to get a death benefit or you're going to be using it for your care. Versus traditional long-term care, which is use it or lose it. You pay a premium every year, and if you don't need the care, then there's no funds coming to you or your beneficiaries.
Robin, and the one we're working on right now,
Uh-huh.
the woman is about to retire from the federal government, and she's going to take a pension that's payable over her life.
Uh-huh.
So you get a higher pension amount if you just take it over one person's life, or the majority, I should say, of one person's life. And women tend to live longer than men. So like that plan makes sense, but you could be wrong. Like you could retire at 63, have a heart attack at 64, and then that pension stops. So the current plan that the three of us are working on is not only will it provide the long-term care, it'll provide the payment to death benefit to heirs so the money comes back, but it's also like a hedge against that pension stopping. Because if she takes the pension, I don't think it's going to happen. If she died the next day, guess what? No more pension. So the husband then loses that income stream that he was essentially planning on for a happy retirement with his spouse. So I like this particular plan the three of us are working on. I think it's a good fit.
Yeah.
But we got to qualify. So we got to go through medical underwriting to see if the person qualifies for it.
So if you guys
Yeah.
want more about long-term care insurance, make sure you reach out to your advisor today. Happy Friday, guys.